right, let's squeeze in a mad dash for an opening bell. Kimberly Clark.
They announced a restructuring on Mad Money, Michael Shue, and it was a restructuring that really put the wood to a lot of people because they felt that they didn't need as many, and it was very tough to do. Obviously, this is a kind of almost like a family-like environment, but you saw it. You saw the greatness. There had been a lot of different things. Your earnings per share now looking for low teens. It had been high single digit. Revenues, they were looking for now high single digit. They were looking for mid single digit to low single digit. I mean, this is just a remarkable turn.
So the guidance has improved dramatically.
Yes.
Along with this
and revenues report. Are good. Revenues are good. The $2 billion free cash flow is extraordinary. I cannot believe the guy was like hiding in plain sight. He came on, he announced it. It was a remarkable restructuring. Nobody cared at all. I told him I think his stock's gonna be up a couple bucks tomorrow. Completely wrong. Delayed reaction. This is what I mentioned about the market getting things wrong. Look at that. Right. He told you everything. Everything.
But you got to make sure they can actually execute.
I think he's an executioner.
Let's get to the opening bell here in the CNBC Real-Time Exchange. And the big board is Lithia Motors, an auto dealership at the NASDAQ medical device company QT Imaging Holdings.
I happen to like LAD very much. This is Lithia and Driveway. It's a very, very good company. The stock's been down. I think it's a kind of interesting one. It sells at 7 times earnings, apropos what we were talking about, anything auto. Brian DeBoer is terrific, and he lives in the town of Ashland, where my daughter lived.
Very nice.
And this was where my daughter bought her car, and it's like it was a fabulous experience. It's almost as good as Carvana, David.
Almost
as good as Carvana.
Carvana's got the giant.
Well, you put the coin in.
Giant vending machine car thing.
Well, can't
beat that.
It's unstoppable.
Yeah.
Tell you what's interesting, Jim, is some of the commodity action today. Copper, worst day in a week. Aluminum, nickel, worst day in a year or two. Cocoa down 7. Oil below 82.
I knew cocoa was going to crash. That's why Hershey never really got crushed. You buy Hershey here because when you have a parabolic move in cocoa, it has always ended so badly that they obliterate the commodity. Let's see if coffee gets hit. That's been up 25%. I think Nucor last night. Yeah. I happen to like Nucor very much. They're going to be on. Obviously, people are thinking that the worst is here. There were some actual things involving. Restructuring of internal costs, but there were a lot of in March there was a lot of weakness, and I'm beginning to develop along with my brown shoots a March weakness theory.
That's interesting.
Yeah.
Sherwin-Williams, demand choppiness.
March weakness.
That's a double miss.
March weakness. That was very surprising. Are people selling Home Depot on that? I don't know.
Even UPS, Jim, average daily volume down 3, although Carol Tomei said
she made
improved
pledges
during the quarter.
She made pledges. There are people who feel that she's too optimistic. I think that she made a pledge and she's going to live up to it. I actually believe in her here. I think she's going to live up to it.
You do?
Yes, because there was no need to do it. No need to do it whatsoever. She did not need to put herself out.
Well, the stock is up fractionally, at least, in the early going. I got a stock that's up a lot more than that.
Novartis?
Nope. Nope. Keep trying.
IBRX?
Nope. Spotify.
You had to do that.
What do you mean, had to do it? It's up 14%. Was upsetting you somehow?
No, it's just that it's just so good. When I did my game plan this week, I said, listen,
about
just go buy
Spotify
Spotify. No, I said go buy Spotify. No one listens. No one cares.
No one cares.
I do the show in a mirror.
Yes, you might as well.
I said, just go buy Spotify. Like, here's my game plan. Go buy Spotify.
Why don't you just go down by the subway there, stand on the street, and do the show there?
I would do it.
Yeah.
Buy shine shoes.
Yeah, why not?
I don't know. I said this is my best one for next week. No one cares.
3.64 billion euro, a bit above the street. Gross margin was 27.6%. That was better than had been anticipated by many of the analysts who follow the company. The operating margin of 4.6%, again above at least where many analysts were at 4.2%. And they did guide for the second quarter premium subscribers to 245 million. That was a little bit below, I'm told. But overall, guys, as you get the picture here, margins, earnings,
right.
And
the average revenue per user is extraordinary year over year. 615 million versus 550 million. David, this is the way Netflix used to be. Remember when Netflix, what it would be like, the numbers would come out and you'd say, like, wow, how'd they do that? This is the new Netflix. The current Netflix
They've
is the
been
old.
focusing to a certain extent on efficiencies like so many other companies. Remember, the podcasting effort has definitely waned and how much money they were spending on that.
Although price hikes are getting digested pretty well. Deutsche last week went to $3.40. They were at $2.60, Jim, because they think the price hike got so well as received, there's going to be more.
Well, I just think that it's an extremely well-run company. Julia Boorstin had some very good comments. She spoke with Danek, and all I can say is that this is a company that is chronically undervalued, and I don't understand it. I mean, can't people understand it's a good company? It's a subscription business. One of the things that we've learned to love is if you have a subscription business, the stock can go higher. Now, Netflix, when they talked about the idea that you can no longer multiply the person by the fee, that was so hated.
Netflix saying a year from now they're going to no longer give us their KPIs, no longer give us subscription numbers. Killed it.
Just killed it. Just give it to us.
And by the way, why did you need to tell us a year out other than you think they're not going to be so good?
It was a suboptimal call, and I love Netflix, but holy cow, that call was like, hey, let me be the bad guy. We're not going to give you what you want. Let me be the bad guy. Why do I need a bad guy for? I just want good guys.
How about Wells taking Disney to 141?
Oh, my God. That was like, wow. Nirvana, talking about the parks being strong. I mean, the stock kind of has been weak since, say, Nelson didn't win that.
Yeah, a bit weak, but the market caps are converging once again, Netflix and Disney. It's always interesting to watch them.
Well, did you read the Wells note?
I mean, Netflix is still, let's call it 40 billion, almost 40 billion bigger, but...
You had to do that, yeah.
What? I had to do what?
No, it's like the comparison is fatuous.
It's a
fatuous comparison.
What, Netflix and Disney?
Well, it's
Market
endless.
caps?
I'm like tired of it.
You're tired of it? I haven't done it in
having
years.
gone through the proxy war, I don't need to hear it anymore. I still think that Nelson could have been a value person.
Oh, my God. We're still going to be hearing about this? Hey, you lost. Your side lost.
Me, I lost.
You lost.
I lost.
Yes, right. You lost.
Yeah, you're right.
Was it rigged, Jim?
Yeah, it was. I planted the Nelson article in the Times. Okay? You planted the Nelson article in the Journal.
I was like, yeah, which one was the nice one? By the way,
why did that Wells piece come out? What was the genesis of the Wells piece?
I don't know.
I mean, with the proxy fight over, we think management will focus on execution, sports stabilizing,
Where was that?
DTC upside.
That's why Jimmy Pitaro should be named the CEO.
Oh, my God.
But okay. When I worked for Roger
By the way, that
Ailes,
is not a
when I worked for
surprise.
Roger
And yes,
Ailes,
we know
he
that
said, what?
That they're going to be focused on doing all the things they said they're going to do. So they continue to. Wells apparently thinks they're going to be successful at it. Moving on. Warner Brothers
My
Discovery,
Travel Trust has a huge position
which
in
you
Disney.
have been somewhat supportive of lately. Warner Brothers Discovery.
He had good seats last night, right behind the Sixers.
Zaslav?
Right behind the Sixers.
Oh, yeah, with McEnroe, right?
Yeah, really amazing
wow.
seats.
Interesting.
Yeah, see, that
choice.
stopped you. That stopped you in your tracks.
Yeah.
Yeah. You were like talking. You were
Johnny
like,
Matt was
I
a Queens
come up
boy
with
like me. Went to the same high school. All right. Wolf Research this morning. What?
You went to the same high school?
Yeah. 44 billion of gross debt equals 9 years run rate free cash flow. Sits atop 2024 EBITDA of 9.8 billion. And that forecast relies upon 7.5 billion of high margin linear TV advertising, whose decline keeps accelerating. With these exposures and the bulk of merger synergies realized, we fear EBITDA peaked last year. They go to an underperform. Price target,
I know.
$7.
$7. Jesus. I guess that's the end of the Knicks tickets.
Oh, I don't think so.
Oh, really?
No, comp is fine. Comp is fine there because it's based on free cash flow. A lot of the metrics, well, 27 million, and then the additional Zaz comp is based on free cash flow metrics.
Okay, I'm going to tell you something. I am rooting for him. All right?
Who?
Zaz.
Of course. Why not?
Okay, I just want to be sure
colleague of
you're
mine.
okay with it.
30 years.
I thought this piece was breakthrough because it said Turner over earning on agent NBA deal. Agent. What does that agent mean? It's like, the Zaz. Didn't we already went through this thing yesterday where I said that I think that Jassy would like more, and Jassy said no. So, but we don't know what Apple wants.
No, but the NBA deal is going to be a lot more expensive, and do they have the wherewithal to continue to actually have the same amount of games they do now at Warner Bros. Discovery? Probably not. Oh, here's a nice end to a game. Oh, is that the Knicks? Oh, yeah.
NBA draft this week.
That's
Stay
right.
focused.
And there's OG hitting the final free throw. Sorry.
Oh, why don't you get it? Were you Doris Burke?
Yeah. Well, we didn't have the
Doris Burke with
Villanova
me.
guys. They're amazing,
So-
aren't they? Okay.
Stiller in favor.
You want to talk about this Capri, the FTC? And,
Yes,
Tapestry
I
and
do,
Capri?
because it's about time that we talked about
It
that.
is. It's an important moment again here in terms of antitrust, something we have talked about so consistently now for years. Of course, the FTC being more aggressive than we've seen in a long time under its leader Lena Khan. And they've come after what they call the accessible luxury market. That's not a market they made up. That's, in fact, what the companies involved here have been calling this market for some time.
They have.
Accessible luxury handbags, and they say, it's going to create a colossus dwarfing all other market players. They go on to point out that accessible luxury is very distinct from what the parties and other industry
Versus
players call luxury.
Or true luxury.
Yes, and these elite brands also claim affluent, high-wealth consumers in contrast to the millions of working and middle-class clientele who comprise a large part of the customer base for Coach, Kate Spade, and, of course, Michael Kors, which is a part of the company being acquired here, which is Capri by Tapestry. And the price was $57, is $57 a share. You can see when we look at the stock, it is well below that, but there is believed to be even more downside if, in fact, this deal were to be upheld by a court. Let me give you a few things here. First of all, it was a 5-0 vote from the commissioners.
Right.
There are 2 Republicans. They were appointed by President Biden. Nonetheless, interesting to see a 5-0 vote from the commissioners. It's not that often that you see that, or at least when you've got 2 of the 5 are Republicans. The level of redactions in the complaint itself is very high, so it's tough to gauge the level of bad documents that they're relying on. Bad in terms of bad for Tapestry and Capri, because it points to a lot of different competitive things that they may have been sharing. And then, of course, they're going to contest this market definition, even though it's their own, Jim. And they're going to say probably, listen, yeah, together we represent 50% of this market that you're making up, even though they, of course, have made it up themselves. But there are still 50% of that market that is made up of very serious competitors in all forms, although many of them, I'm told, do not have brick and mortar stores. So market definition will be important, and we'll have to wait and see.
I'm for the FTC on this.
Are you?
Yeah, I am. Because I thought it was a very well-written brief.
Wow, I did not expect that.
No, I am. And the most important thing is the competition between the parties today benefit not just consumers, but other constituencies such as employees. The fact is that I've been not that big a fan of the FTC because I don't think they care as much about the consumers. They care about other constituencies. This was spot on. I did not realize how concentrated this business is. I think it'd be very difficult to be able to get a lot of floor space. And these 2 companies, they go at it hammer and tongs.
Yeah.
So we actually have a consumer who benefits from this. So I'm with the FTC on this. That's interesting because the Republicans are too.
Yeah.
Because this has to do with the consumer, which is what I really care about.
Well, apparently what they're claiming is the middle-class consumer who buys these accessible luxury brands. For their part, I don't know if we had anything from the companies. They're saying there's no question this is pro-competitive, pro-consumer deal. The FTC fundamentally misunderstands both the marketplace and the way in which consumers shop, and they say both companies operate in an intensely competitive and highly fragmented industry alongside hundreds of rival brands, including both established players and new entrants.
Well,
it will be an interesting one to watch. They've got a judge, Judge Kodal. He was a Clinton appointee in the U.S. District Judge for the Southern District, so it is here, not far from here in New York. Started in September of '94. And has worked on a number of important cases. Let me give you a quick rundown on Kodal, just if you want to actually try and figure that out. No antitrust opinions, at least, as a first quick look. He did dismiss the DNC suit against WikiLeaks, Russia and Trump campaign as well, alleging Russian interference in the 2016 election. So, people are looking at his decisions to try and figure out where he's going to come down, Jim.
Do you see numeral 5 here? The proposed acquisition will eliminate direct head-to-head competition. David, then it's all redacted. I think they've got a home run here.
There's so many redactions, and that does point to
the FTC.
it's tough to gauge what
I think the
they've got.
FTC has documents. I think they've got good
Yeah,
stuff.
the question is how many are really bad for the,
Well,
for the
you
defendants.
look, I'm against head-to-head competition combining because that's what happened with the airlines. Now, you can say, obviously, it's a fractured market, but this is a very well-reasoned brief. And it is true that the consumers benefited from head-to-head. I like anything the FTC does that's pro-consumer, I'm all in favor of. But I just think they haven't
you're
done
nothing
enough.
if not surprising sometimes, Jim. And let's not forget, he did go to law school.
I didn't go to law school to get stupid.
No.
There you go.
Jim, some of the biggest earnings gainers we've not mentioned, that is Danaher, #1 S&P-er,
Thank you.
Quest, and KMB.
All right, so let's go. Danaher's one of my large positions for my charitable trust. I have waited, and I even mentioned it to Larry Culp today because he did that deal. I have waited and waited and waited for this company to have the inflection, and this is the inflection. The inflection is that they do equipment that's really great for biotechs, and there have been enough new biotechs, companies that came public that have money, that they are now finally doing what I thought they would do, which is to go to Danaher, buy the equipment that you need to sequence, buy the equipment that you need to be able to develop really good new drugs. And this stock, dare I say, this is day one of a very big move. Now, it is a charitable trust name. I do have my my club meeting tomorrow at 12 o'clock. But this is one that I said there's going to be an inflection point, and you have to be in ahead of it, because if you're not going to be able to catch it. And that's exactly what happened. And Danaher, you know that Danaher's a well-run company, David.
It is, but it's been, I mean...
Renee's good, Renee Blair.
Shareholders became so accustomed for so many years for just nothing but an incredible performance and stock price, and that changed over the last couple of years.
2.5 years.
Yeah.
You're absolutely right.
I would point out shares of TMO, are also up on the back of these numbers, right?
Doppelganger there.
Yeah.
But I just think that David's absolutely right. My trouble, unfortunately, bought some Danaher when it was down, but it has been a huge struggle because, Carl, these guys were in the never miss category, and that's why they had such a high multiple. And I think this is the beginning back to the never miss, because there's so much money coming into biotechs. We see that all the time now. We see the deals work. Doesn't hurt that they reported on the same day as a Novartis, which is pretty good. But I just am very glad that these guys, who have been like clockwork, are back. Danaher's back.
Let's get some PMIs this morning as well, and welcome back Rick Santelli. Hey, Rick.
Hi, Carl and Dee. We're looking at markets moving on these data points. S&P Global PMIs. We know manufacturing's been a bit bumpy. We had 3 months above 50, but not this month. We break the streak, 49.9, and interest rates have dropped about 3 or 4 basis points on the 10s, and the 2s, of course, moving further away from 5%. 49.9, that's the first read under 50 since the end of last year when we were at 47.9. Now, we know that the service sector's been much stronger, and we now have 15 above 50. That's 1.5 above 50, but still a disappointment. 50.9, we're looking for number 52 or higher. And if we look at the composite, also the 15th consecutive month above 50, but also a weaker read, 50.9 on both services and composite. 50.9 is the weakest. Well, you have to go back to November of last year. So we are watching rates drop. We have a 2-year note auction at 1 Eastern, the biggest ever at $69 billion. That's going to be something to pay attention to. Squawk on the Street will return after a short break.
Join Jim.
Watch ARC today. Jim mentioned Kathy Wood buying some Tesla in recent days, but tough piece in the Journal this morning looking at the $2.2 billion in net outflows so far this year, which more than surpasses the total from 2023. Meantime, Dow's up 155, inching back to 50-50, just a few points shy. Stop Trading with Jim's coming up next.
$50% off.
Time for Jim and Stop Trading.
It reminds me of when I was in Guys and Dolls. I got a horse right here. Its name is Service Now. Reports tomorrow, and I think it's going to be blowout. I didn't want to go out on a limb other than the fact that SAP had an amazing quarter. That was Bill McDermott's previous company. Really an amazing quarter, using a lot of AI as a service now. SAP on tonight for Mad Money, and I think that you buy Service Now at 733 and 735 now, and I think you make some money.
Are you more Sky Masterson or Nicely?
No, I was Harry the Horse.
Ah, nice.
Second rate. Second, you know how when you go out for the big one and you just don't get it? Just so bad.
Jim, tonight?
Okay, so I have Nucor, which has got Nucor actually missed the quarter. They had some reasons that had to do with internal, but some of the pricing didn't hold up. A la Cleveland Cliffs.
Well, we actually have a minute here. Nucor and Cleveland Cliffs both down. Cleveland Cliffs down about 8%.
March was a bad month in this country. That's my theme.
Obviously
was a
reiterating on the call all the reasons why.
Yep.
Nippon will not succeed in buying U.S. Steel,
right,
but
that was pretty great.
But what about the overall business for Nucor and Cleveland?
Well, Nucor, I'm going to challenge him. I think that Nucor March was not that good on a series of grades of steel. I think that this is just like the PMI that Rick talked about. The PMI was weak. I think the Fed's going to get bailed out here. No one's thinking that. I'm going there. I would like to see the home builders get hurt. We need shelter to come down. Shelter has not come down.
Actually, Morgan Stanley, nice chart today looking at leading indicators of shelter. Second half, they think, will lead to more disinflation.
then you're okay. Then we're home free.
Yeah.
You're home free, and you want to buy them after we have another touch. You know, we had a big oversold, then we're bouncing back, and then we're gonna have another oversold. It's gonna be the same situation that we had last October. And I think that after the second decline down, you're gonna be so tempted. You gotta wait for a third decline. Everything will depend on, in the end, NVIDIA, which if you go listen to his amazing discussion at Oregon State that he had with the president of Oregon State, you will realize why Jensen Huang is the most brilliant man in the world today. Not Mr.
Elon?
Not Mr. 50, but the $56 million man?
Well, he's not anymore. The compensation for Elon has come down to like 46, maybe even less, given the decline in Tesla's
That's
stock
what's the
price.
problem with America. Wouldn't it have been great if he had made 56? That's what we're talking about. That's America, Mr. Handbag.
I'm Mr. Handbag.
Mr. Handbag.
Oh, thank you.
I'm bringing in Michael Kors tomorrow. You're gonna see why the FTC's dead right on this.
Jim Cramer aligning with Lena Khan.
Yes.
Miracles will never
Khan,
cease.
Cantor, Wu, and Kramer.
You betcha.
Attorneys at law.
Yeah.
You betcha.
There you go.
There's a firm.
Fighting.
Defenders.
Fighting for middle-class, accessible handbaggery.
Jim, we'll see you at 6. Mad Money, of course, 6 p.m. Eastern Time, as the S&P does reclaim 50-50. Don't go away.
DC.
Good Tuesday morning and welcome to another hour of Squawk on the Street. I'm Carl Quintanilla with David Faber, Leslie Picker, live at Post 9 of the New York Stock Exchange. Sarah Eisen has the morning off. S&P working on its best two-day gain in a couple of months now, since late February, as we are moving into a new chapter of corporate earnings with a lot of consumer and industrial names. Yields are a bit elevated, but the VIX getting back to 16.
And as goes those earnings season, so does the movers. We're 30 minutes into the trading session. Here are those movers we are watching. Shares of JetBlue plunging right now. Losses at the airline widened significantly, and it also cut its annual revenue forecast. An oversupply in Latin America weighing on those results. You can see shares down more than 11%, 11.5% right now. We'll break down the numbers with their CEO next hour on Money Movers. GE Aerospace headed higher, the jet engine maker reporting their first quarterly results and separating from GE's power business. Revenues were up more than 10% year over year. They boosted guidance, and you can see the shares reacting favorably, up about 4%. And we're keeping a close eye on Tesla, the stock trying to avoid its longest daily losing streak ever. The EV maker gearing up to report earnings later today. Much more on that anticipated moment a little bit later in the show. Up 2% right now, those
All
shares.
right, but before that, we'll get some economic data that just crossed the tape. Rick Santelli has it for us. Rick.
Yes, David. Richmond Fed, these are April, so real time. Richmond Fed manufacturing -7. That's 6 consecutive negative months in a row. Not good. And if we look at business conditions, which is the service sector, it is the -6, a much worse number than anticipated. Haven't had a positive integer on the service sector since August of last year. Now for the big number, March new home sales expected to be in the 670,000 area. That's seasonally adjusted annualized units. It's better, 693,000. That is the best since September, and it does underscore with such a weak inventory of existing home sales and March existing home sales being a bit lower, many expected this number to be higher. And we did see a revision in the rearview mirror, which takes some of the fun away. 662,000 last month now becomes 637,000. And for more on new home sales, let's head east to Diana Olick. Diana?
Well, Rick, this is a surprise to the upside, but not totally unexpected, because I want to look at mortgage rates specifically. We know that today's buyers are incredibly rate sensitive. And while in February, the 30-year fixed was solidly over 7% for most of the month, in March, it was a mix. It came down, it went up a little bit, then it came down again. We know the big builders are buying down mortgage rates, and some of them are incentives that we see. And I want to turn for a minute to Pulte, which just reported earnings this morning. They're the nation's third largest home builder. They reported a strong first quarter earnings and increased guidance. They did not lower prices. In fact, they raised them slightly, which helped juice their margins. Now, they are using rate buydowns, saying that the average Pulte buyer was getting a 5.75% starting rate as opposed to the 7% rates we're seeing now. Now we're actually up at 7.5%. They did note a sharp increase in first-time buyers, but also said that given the recent increase in rates to now close to 7.5%, they're seeing, quote, some moderation in traffic and may have to look at lowering prices. And of course, we'll have an exclusive interview with Pulte CEO Ryan Marshall coming up in the next hour on Money Movers. Carl?
Thanks for that, Diana Olick. A busy day for data. Also a busy day for earnings from the automakers. GM rallying on this huge beat. And Tesla, of course, tonight after the bell as it tries to end one of its longest daily losing streaks in its history. Let's get to Phil LeBeau, who's covering it all. Morning, Phil.
Higher today after reporting better than expected, much better than expected earnings for the first quarter. Take a look at shares up more than 5% earlier today. As you take a look at the stock, keep in mind that this is a company, it's up now 4.5% for the day. Their adjusted EPS, $2.62 a share for the first quarter. The most optimistic estimate on Wall Street was $2.53 a share. What was driving GM in the first quarter? North American adjusted profit margin, 10.6%. That's better than people were expecting. Average transaction price, it hasn't fallen as much as many feared. Still holding at about $50,000, roughly flat compared to a year ago. Strong pickup truck demand. Here's the CFO, Paul Jacobson, this morning on Squawk Box.
We have seen, some effects on lease rates and the leasing portfolio, obviously, where people turn vehicles faster and where we drive a lot of loyalty. GM Financial has continued to trend well in that space. So I think it's a little bit too soon to tell based on where interest rates are and how long they've been here. But as we've seen, the customer has been really resilient as it relates to our products over this time period.
That's Paul talking about the impact of higher auto loan interest rates on the consumer. And as he said, they really haven't noticed a huge impact at this point. They are raising their full year EPS and free cash flow guidance. Again, shares of GM up almost 5%, following much better than expected earnings and a much better than expected forecast as they raise for the full year. Compare that with Tesla. And this is all about what we're going to hear after the bell today as Tesla tries to move higher after a string of days where the stock has been pushed lower. The Q1 results do come after the bell. And what we want to hear, what the street wants to hear, I shouldn't say we, what the investor wants to hear after the bell in the conference call with Elon Musk. What's the delivery guidance for this year? Most have brought down their estimate for full year deliveries to 1.9 million. They did 1.8 million last year. What's the update on the Model 2 and the robotaxi? We've only had vague references so far in terms of some articles talking about what Elon Musk might be doing. And then what does he say during the conference call? And how specific does he get during that conference call? Those are the things that people will be focused on, especially during the conference call, guys. I cannot stress it enough. I know we talk about it every quarter, saying that's what people are going to be focused on. This quarter, that really is the case because no one's quite sure what the near-term and longer-term outlook is for Tesla. They're hoping for some guidance from Elon after the call.
Phil, to turn back to GM, shares of which have just eclipsed a more than 5% rise. I asked this earlier. I mean, what did the analysts who follow the company miss, given it was such a sizable beat, not to mention guidance obviously moving up? Is it simply, well, let me just leave it at that. What did, if anything, they sort of not fully account for?
I think part of it is I think they failed to appreciate in North America that pricing held up a little bit better than expected. Remember, GM had said, I want to say about 6 weeks ago, look, for the year, pricing is going to be down 2 to 2.5%. That really hasn't kicked in yet, and I think there is maybe a lack of appreciation for the fact that the transaction prices have held as strong as they have. And the demand is there, David. We are not seeing a slowdown in the consumer demand. And that's manifested in both the sales numbers as well as the transaction prices. So General Motors, I think, doing better than expected in those two areas in North America, probably underappreciated by Wall Street.
Phil, appreciate that. Obviously, we're waiting to see what Tesla says tonight. That's our Phil LeBeau on the busy day for autos. Let's get Wall Street's take on this market as earnings season now kicking into higher gear. Joining us at Post 9 this morning, Goldman Sachs Chief U.S. Equity Strategist David Kostin has kept that target of 5,200. DK, it's great to have you back.
Nice to see you again, Carl.
Is the year playing out kind of as you expected?
Pretty much. The market at a little over 5,000 would suggest maybe a couple of percent appreciation from now till the end of the year. And the expectation is, what are we seeing now for the first quarter results? We're about 16% of the way through earnings season. We've seen thus far, most of the companies, about 65% of the companies have actually beat consensus expectations on the bottom line, and about a third have beat expectations on the top line. What that suggests to us is that companies are able and have been demonstrating the ability to kind of squeak over a little bit margin, and margin is basically hold there until a little bit higher. That's something I heard last week. I was in Chicago. We had dinner with 20 CEOs, discussion point about who was able to raise prices. The answer was not a lot of price action, but there was some desire to try to raise prices, but it didn't get that strong indication there's a lot of inflation coming. So our forecast is that market rises slowly in line with expectations for earnings.
Any reason to doubt that the coming quarters will bring further improvement in margins?
There's not a reason necessarily to doubt that Goldman Sachs economics view is that inflation will ultimately move lower by the end of the year, and rates will also come a little bit lower. So that's sort of the expectation we have in our model, is that earnings will be roughly, margins will be roughly flat, and that ultimately it's a little bit about economic growth will drive sales, and that's largely the reason for earnings to be higher for this year.
I'm curious about your point about, it feels like there is this inflection point with regard to companies' ability to continue passing those price increases to their customers. I'm curious what you think that means, though, for margins moving forward. In that conversation with those CEOs, did it feel like they would be taking additional pain themselves rather than being able to pass that along?
So one of the comments that came from one of the CEOs was rather changing some of the terms of service. as opposed to necessarily push prices and try to maintain their market share. That was really the discussion point that was interesting. There was a lot of consumer companies, a lot of industrial companies, a couple of financials that were around the table and talking about business activity. Business activity was pretty strong. Their characterization of it, but not necessarily that they're able to push through a lot of price increases. Some, but not a lot.
Are rates going to drive this market, or is it now going to be earnings? I mean, I look at it today. Certainly, we had a very positive market, perhaps based on what have been strong earnings and guidance from a number of companies.
Well, right now, it's about earnings. A week and a half ago, everyone was focusing on inflation and rates. That was the big discussion point with clients. Right now, this is the heart. This particular week and next week will be most of the conversations we're having will be around earnings, margins, whether companies can deliver on expectations or perhaps beat expectations. Put this in context, the expectation right now is for 3% year-over-year growth in earnings. To be very clear, 3%, it's a pretty low bar.
Yes.
The last 4 quarters, David, the actual results have been about 400 basis points greater than expectations. So if you had that pattern persist for this quarter, it'd be something like year-over-year growth of earnings of around 7%. Again, expectation is 3. So pretty low bar. As I said earlier to Carl, they're basically around 2/3 of the companies are actually beating their results in terms of earnings. So that's pretty consistent with what we've seen in the last several quarters.
That said, your desk has recently written about lower CTA liquidity, cutting exposure even on pullbacks. Maybe this pullback has more to go. Can you get that granular on it?
Well, that's a sort of tactical view that would suggest to us suggest to me is that earnings season is really what's going to drive the story. And you saw the example with GM this morning. If there's positive results, stocks will go higher. And the idea of most of the companies thus far coming in better than expected for earnings season has been a key area. Another big area has been focus of discussion on how companies will spend their cash for this year. About $3.7 trillion of money will be spent, cash spending. Over $1 trillion will be spent on investing for growth, CapEx and R&D. Investors are definitely focused in that area. If the economy continues to grow, companies that prioritize that as a source and a use of cash will actually be rewarded.
David, we'll see. We're just getting into it, as you say, 16% in. Good to see you.
Thank you.
David Costin, Goldman Sachs. Let's get to Steve Kovac with some breaking news on Apple this morning. Hey, Steve.
Hey there, Carl. Yeah, May 7th, there's going to be an Apple event. This is going to be a virtual event streamed on Apple.com, probably YouTube as well. And we're expecting this one to be new iPads. And this is important, Carl, because last year, all of 2023 was the first year that, at least I can remember, Apple didn't put out a new model of iPad. As a result, sales have just been way down from those COVID highs that we saw, people just snapping up all those iPads and MacBooks. And we're also expecting this, Carl, to be a significant revamp of the iPad lineup, including the iPad Pro. Bloomberg and others have reported that there are going to be some significant updates to the screen and things like that. Also, some lower-end models of the iPad as well. But look, today we got that headline out of China saying sales of iPhones in that country were down about 19%. That is what everyone's really focusing on more than the iPad business. It's can the iPhone business turn around, especially in China, Carl?
We always try to read the tea leaves behind the announcement. What do you think let loose means, Steve?
I don't know what let loose means, but I do know there is an Apple Pencil, that stylus for the iPad on there. So, I mean, you can't get more clear than that. This is going to be an iPad event.
Well, hopefully it's not too loose that you lose
Yeah,
it.
exactly. It does attach with a magnet, so I think it's okay.
Okay. Well, yeah, for most people.
Yeah.
We'll see. Steve, thank you.
Thanks.
As we head to break, here's our roadmap for the rest of the hour. New data showing Apple smartphone shipments, we were just talking about this, plunging in China. We will head live to Beijing for the details and the fallout.
Plus, short sellers seem to be making some big bets against big tech. We're going to tell you which names are in their crosshairs.
And Pulte beating earnings as this saying there's a shortage of, quote, several million homes. We will get the pulse of the home selling season right now with the CEO of Compass later on this hour. A Squawk on the Street continues. Busy day for earnings. Pepsi beat estimates. Higher prices helped offset a small drop in volume. Organic growth fell 2%. Volume growth, largely driven by a slowdown in beverages. The CEO spoke on the conference call saying the consumer globally is very resilient, but that the lower income consumer in the U.S. is a bit stretched, hanging on to gains for the year, just barely underperforming the S&P so far in 24.
And of course, down about 2.8% today. We're a little over a week away from Apple earnings, and Barclays out with a new note ahead of the print saying they expect the company's guidance for the June quarter to miss estimates due to softening hardware and iPhone demand. A key part of the slowdown story, well, it's China. Let's get to Eunice Yoon in Beijing with new data out there on Apple. Eunice.
Thanks so much, Leslie. Well, Apple, as you had said, had its worst quarter in terms of iPhone sales in China since the start of the pandemic. Counterpart Research says that in terms of market share, Apple slipped from first to third place, losing out mainly to local rival Huawei, whose market share has risen by 70%. Now, in terms of the overall smartphone market, the research firm said that in Q1, the market expanded by 1.5%. Now, the drop coincides with the CEO, Tim Cook's charm offensive when he came here, visited a flagship store, also spoke with state media, really talking up how important China is, critical, he says, for its supply chain. It also comes at a period when the Chinese tend to actually spend a lot more because it's the Lunar New Year holiday. It's seen as a big time when people like to splash out cash. However, because of the overall environment here, with the downturn, people have been a lot tighter with money. Now, in terms of discounts, Apple has been trying to offer lower prices to get more people to buy their iPhone 15. These are the sale prices as of today, down by as much as 20% from the original price since because of the concerns about people not buying enough. Apple does have, of course, other challenges that it faces, some quite specific to Apple and as well as other foreign devices, broader restrictions on these devices at state firms and agencies, and also, of course, that tougher competition that I had mentioned from the local rivals, including Huawei. Huawei has just last week come out with another lineup of high-end phones. This is the Pura 70 series, and this is after, as we've talked about a lot, the Mate 60 last year was rolled out and was really seen as Huawei's comeback and ability to overcome the U.S. challenges, controls, and other restrictions on its chips. Guys?
Eunice, you know, the resurgence of Huawei itself is interesting. I mean, for so many people here in the States, what they may remember is essentially the U.S. government almost putting it out of business in terms of export restrictions. What has been behind that? How have they rebuilt the company and the product to the extent that it can now really compete effectively with the iPhone?
Well, I mean, with Huawei, they have said that they are focused very much on their technology. So it's always been a mystery as to exactly what's behind the Mate 60. They haven't outright said that they were using any 5G chips. All we know is that the speeds are as close to 5G as possible. So that's really been trumped up by Huawei, and people have been buying the phones. When the phones have come out, there have been people lining up to get them for this Pura 70 series. People were saying that they wanted to be able to get their hands on them. Even you have to line up just to get the reservation, and there was no guarantee that you'd be able to get this phone. So they have been able to really get people excited about their phones. And then there is a bit of a nationalism line where there are folks who do think that they should be buying made in China phones that are not only made in China, but made by a Chinese company.
That explains some of Cook's travels to China recently, Eunice. Thank you, Eunice Yoon. An important story regarding China and Apple. Meantime, still ahead, short sellers making some big bets against big tech. We'll tell you which names they're targeting and just how much they're making after this.
passive income.
Welcome back. Take a look at shares of Spotify, up nearly 13.5% right now. The music streaming company beat earnings estimates despite slightly slower than expected user growth. Revenue climbed 20% and monthly active users rose 19% from a year ago to 615 million, though short of its previous guidance. Today's gains pushing the stock up more than 60%, about 65% this year. Got to wonder where Taylor Swift and Beyonce fit into this momentum here as well. Carl.
Meantime, Kathy Wood's once high-flying ARK Innovation ETF, ARKK, continues to struggle in 24, down around 15% this year. That's underperforming the S&P, obviously. 4 of the top 5 holdings for the ETF are negative on the year, led by Tesla, the group's largest holding by weight. Coinbase, the only outperformer among those names. This year's struggle leading investors to pull some money out of Kathy Wood's funds. According to FactSet, investors have pulled a net $2.2 billion from her 6 funds already this year, and total assets have dropped 30% in 2024 to about $11 billion, far below the peak in 21 when assets touched nearly $60 billion. It is lower on a 2-year, on a 5-year, dramatically underperforming the S&P.
Yeah, and I mean, one of the big drivers of the S&P has been this tailwind for AI. You look at those top holdings, none of them are really playing into that theme. So it's not a surprise that those are the ones that are underperforming and that people are pulling their money out of the ARK funds and probably putting them either into treasuries where they can get a decent return or into maybe some of the Mag 7 names.
Yeah, I mean, she had owned NVIDIA for quite some time, but made a poor decision to sell it in 2023 prior to it's almost quadrupling.
Yeah.
The enormous accretion of value, obviously, is the key play for so many investors when it comes to AI. And of course, I can remember, Carl, that period of time when we were talking, about ARK every day back in 21, 22. You almost could foreshadow. You knew that watching assets accrue that quickly to that strategy after she had obviously some very strong performance.
Right. Although some of her macro calls are still up in the air, whether or not technology is going to lead to deflation and the cost of batteries and robots going to fall dramatically. We'll see.
Yeah. And obviously, her Tesla call from way back was still, yeah, very much so. All right. Meanwhile, the Magnificent 7 stocks are seeing a bit of an uptick, this in short interest ahead of their earnings. Kate Rooney joins us now. She has more on what the bears are betting on and just how much. Kate.
Hey, David. Yeah, so last week marked a record windfall for bears betting against big tech short sellers in the Magnificent 7 saw a weekly profit of $10 billion. That was an all-time high during the NASDAQ sell-off. That's according to data firm Ortex. Those tech giants, for the most part, report earnings this week, and they are the most shorted stocks in the U.S. markets, according to S3 Partners. NVIDIA is number 1, followed by Microsoft. Then you got Apple, Tesla, followed by Meta, Amazon, and Alphabet. There has been some negative sentiment around these companies, as you guys have been talking about, Tesla, for example, but short interest may be more about downside protection. So S3's Ihor Duzaniewski tells me that investors are using megacap tech as a way to hedge. It's more efficient than, for example, going long materials and energy. These stocks are also pretty cheap to borrow and short because they're so liquid. He described them as a hedge with serious afterburners, since they tend to get the biggest kick in the teeth if the market goes the wrong way for them. Aside from last week, though, shorting big tech has been a lot less profitable. NVIDIA shorts are down 35% this year. Meta shorts down 27%, again, according to S3. Amazon, Microsoft, and Alphabet bears, they're all in the red. Of the Magnificent 7, it has only been profitable to short Apple and Tesla. Shorting Tesla, though, has been risky over the years. The bears have lost a total of $52.5 billion shorting Tesla since its IPO. You can see there only 2 years have been profitable for short sellers. This is on track to be one of them. Shorts are up about $9 billion, guys.
That trade finally paying off there, Kate. Interesting stuff. Thank you. Speaking of the Mag 7, Tesla shares trying to avoid their longest losing streak ever ahead of earnings tonight. We'll get you ready with one analyst warning of more pain ahead. Strap in. We'll get you ready. We're back after this.
NTVFT.com.
Welcome back to Squawk on the Street. I'm Bertha Coombs with your CNBC News update. The New York judge in Donald Trump's hush money trial will consider today whether the former president violated his gag order in the case. The hearing today will focus on whether Trump attacked likely witnesses on social media. He faces 34 counts of falsifying business records related to an alleged hush money payment to adult film star Stormy Daniels. Trump has pleaded not guilty. Secretary of State Antony Blinken departed for China this morning, his first trip to the country since June. He's expected to raise U.S. concerns over tensions in the South China Sea, the Russian-Ukraine war, as well as the crisis in the Middle East. And NASA's Voyager 1 spacecraft is transmitting data once again after going dark last November. The space agency announced that the 46-year-old probe, which is more than 15 billion miles from Earth, is once again sending engineering updates. The next step is to get science data transmitting again. Voyager 1 and 2 are the only human-made spacecraft to ever fly in interstellar space. Apparently, they found the one chip that was the problem, and they reworked it with a new code update.
Fascinating, Bertha. I love it when you talk some space. Bertha Coombs this morning. We'll get you ready for Tesla in a moment with Colin Langan of Wells Fargo. And still to come, one of America's largest home builders out with a warning about the housing market. We'll tell you what he said and get a read from the ground with the CEO of real estate firm Compass. As we go to break, check out the ETF that tracks the home builders, ITB, on pace for the best day in more than a month. Stay with us.
PC Pro.
Checking the markets on this Tuesday, close to session highs here with 1% gain on the S&P. Nice day for tech and industrials, up more than 1.5%. Got some relief in commodities like the metals and other names like cocoa that have been going parabolic in recent weeks. We'll see what happens. Of course, big earnings continue tonight, David.
Yes, they do. We'll start off now, though, with a company that just reported, GM. And you see that stock is up over 5% after what was a big beat on both the top and bottom lines. Strong North American operations. The automaker also, importantly, raising its 2024 guidance. But not the only automaker in focus today. Tesla will report results after the bell in what has become one of the more important earnings calls in that EV maker's history. The shares, of course, down more than 40% so far this year, up today, but very close to 52-week lows. So here to help us break it all down, Colin Langan is Wells Fargo's auto and mobility analyst, has an underweight rating on Tesla and a $120 price target. And that's been the right call to have had this year, Colin. But before we get to Tesla, just give me a quick read on GM and your thoughts about what obviously seems to be quite strong numbers, particularly in North America.
Yeah, sure. I mean, GM had a very good quarter. I mean, they reported $3.8 billion in adjusted EBIT, better than consensus of $3 billion. I think, volume seemed to have come in better. It was probably the most notable factor. And pricing for them has held in pretty well. It seems to be bucking the trend from some of the data that we see for the industry. That said, I think inventory levels look a little bit high. Full-size pickups demand for the industry is a bit weak in Q1, and that's a huge moneymaker. So those are factors that, probably mean some risk for the rest of the year, in my opinion. And then in general, I'm cautious on all the Detroit 3 automakers. I mean, I think we see pricing headwinds, EV headwinds as those ramp because of the regulations and the unprofitability there. And then, we are concerned and watching closely the full-size pickup segment since it's such a moneymaker for the Detroit 3.
Well, your concern obviously also extends to Tesla, where, as we said, you have not been particularly aggressive on the stock at all. Has it already discounted to a certain extent, given that 40% move down this year, or 41%, the expectations coming into this quarter, Colin?
I think it's a good question because I think almost every investor I've spoken to really expects a miss in the quarter. I would tend to agree. I think the fundamentals are very poor in Q1. I think what I've warned investors about in the very short term on the call is that they do have a history of razzle-dazzling investors, right? I mean, they're probably going to hype up full self-driving and robo-taxi. And, it can dislocate from fundamentals. I think after the call, after the excitement that might be building on low expectations heading in, I think the fundamentals matter again. I think you'll have pretty weak deliveries, price cuts, and I think the question of when will robo-taxi actually hit becomes an important concern.
What is that razzle-dazzle? Is it enough to razzle-dazzle at this point, so to speak? Because we've heard promises on robo-taxis and full self-driving for some time. To be fair, they do have a new iteration of it that relies, on sort of a different underlying, neural networks in a way that they hadn't previously. But is it going to be enough in neural nets in this case to really get people excited, given what we've seen in the past?
I guess to be clear, I think, there's a risk that there's some short-term excitement. We saw very poor Q1 deliveries. The stock fell and then traded back up. So we've seen a dislocation in the very recent near term from fundamentals. We saw news about Model 2, which was an important launch, and questions about what the outlook for that model is. And we saw the stock actually, trade back up after that. So it can dislocate from fundamentals, but then we saw, like in the last week, the fundamentals do ultimately matter. And I do think there's some expectation here. They have it's a new system. I've actually been in it. It is significantly improved. It's pretty impressive for how long it's been out. And I'm sure they're going to be hyping the exponential rate of change of improvements of that system. I still fundamentally don't see it being a robo-taxi anytime soon. And I think there's a lot of work to be done. But I think they're going to probably be talking about the rate of change there and how, building excitement about maybe that coming sooner than people are expecting. And that might be enough to get, the people who are bullish on the stock to buy more.
Based on your, Colin, I'm just curious, based on your experience covering the stock, what is it that kind of shifts investor focus from the fundamentals to what you described to be, razzle-dazzle, hype, and so forth? What is it that the average person can be looking for on the call that would suggest that a shift like that is taking place and they should be kind of mindful in how they're trading the stock today and tomorrow?
I mean, to be very clear, I'm just talking tonight, post-earnings, the reaction, I could see a risk that it pops. I still think the fundamentals matter, and we've seen the fundamentals seem to overweigh that over time. And I think over the month and the month after, we're going to see the fundamentals matter. I do think, people are clearly looking at the long-term story. If you're a buyer of the stock, you're looking at the robo-taxi and the market opportunity there. And considering the low expectations that investors have into the quarter, I don't know that the setup in the very short term is great for the bears. I think fundamentally when deliveries come in, price cuts continue, then I think the story works again.
All right, we'll be paying close attention. Appreciate your insights. Thank you, Colin.
All right, thanks for having me on.
One earnings name seeing some gains is Pulte, one of the nation's biggest home builders. Home sale revenue up 10 year-on-year, closings up 11, and demand remains incredibly strong on the new side, in part due to limited inventory. Take a listen to the company's CEO last hour on the conference call.
The supply of available housing remains tight. We have the long-term structural issue resulting from a decade of underbuilding that has the country short approximately 4 million housing units. At the same time, the available inventory of existing homes for sale continues to be low as homeowners remain locked into their low mortgage rates. Life happens, so we are seeing some additional existing homes come to market, but the numbers remain well below historic rates.
And don't miss Pulte's CEO next hour on Money Movers, beginning at 11 a.m. Eastern.
And new home sales rose more than expected in March to the highest level since September and the biggest monthly gain since December 2022. Meanwhile, Refkin reporting home affordability is on the decline, with nearly 40% of homeowners saying they don't believe they could afford their home if they were to buy it today. Compass co-founder and CEO Robert Refkin joins us now here at Post 9. Thanks for being here, Robert. So let's talk about housing affordability, especially as it pertains to owning a home, renting an apartment. I've been parsing through some of the regional bank data, which suggests multifamily housing is kind of reaching this inflection point as well in terms of its supply-demand dynamic. So how do you see housing affordability at this stage in the cycle?
I think housing affordability will continue to be an issue because 60% of homeowners are locked into low mortgage rates at 4% or below, effectively locking them out of selling their home. And so there's structurally less inventory even before that issue. And then you add that, and so there's more buyers than sellers. And that just leads to prices increasing. Sale prices this year are about 5% above where they were last year.
One thing I thought was really interesting, because we think about this kind of correlation between where the rates are and what it means for housing and what it means for affordability. But you, in the producer's notes, are focused on all cash deals. And basically this idea that as we have more appreciation in the stock market, people tend to crystallize some of those gains, maybe take some gains from fixed income as well, and use that toward buying all cash. How does that dynamic affect, the overall market and the implications on supply as well?
Yeah, the theme of the moment is that although mortgage rates are above 7%, you don't need low mortgage rates if your stock portfolio is at an all-time high. And if you're living in the Bay Area, you're living in Seattle, you're living in New York, these are markets where a lot of the employee base are paid in equity, and that equity is nearing an all-time high. Also, from a buyer perspective, there is actually more inventory now than there has been in years. 30% more inventory today than there was a year ago. And the houses that are available for sale right now have more price drops than any time in the last decade. So there are some positive signs out there.
In terms of, those discounts and price drops, I think everybody, their ears probably perked up with those. Is that enough to really increase demand? I mean, what are you seeing in terms of buyer behavior at this point in time, especially as we look at the prospect for those who aren't fortunate enough to be able to purchase a house with all cash, higher for longer, 20% odds in the options market that the Fed would even hike from here, which would suggest that if you do want to be taking out a mortgage, maybe now could be your time to do that if that's the case. So how is buyer behavior kind of shifting in this new world with discounts, but also the prospect of a more expensive mortgage?
We are seeing more buyer demand than this past fall. This past fall in October, the seasonal adjusted annual rate of home sales was 3.8 million. This past month, it was 4.2 million. So it is modestly moving up. The mid-cycle average should be around 5.3, 5.4 million. So we're far off from where we should be. but it is clear that the bottom is behind us.
Are you seeing more housing affordability and discussions following that settlement, that recent settlement with the National Association of Realtors and a group of home sellers? I saw a recent article that said that standard 6% commission is a thing of the past and that it's going to be much more negotiated downward as much as 25%. Does that make housing more affordable? And what does that mean for your business, which relies very heavily, of course, on those commissions?
Yeah, so the headlines that I read are very different than the facts that I know. NAR doesn't govern the commission, A. B, there is no such thing as a 6% commission. They are all negotiable, they always have been. What I can tell you is that more people are using buyer agents and seller agents over the last decade, pretty consistently. It's at an all-time high right now. I can also tell you that commissions over the last 3 years went up each year, and those are signs that the consumer values advice from a professional agent more than a discount. There are discounts that have been out there forever. There's Foxtons, Purple Bricks. There are mass discounters in every market, but people time and time again are choosing the agent that can give them the best advice.
Commissions went up, on an absolute basis or on a percentage of the...
Commissions in 2021 were around 4.9%. Then they went up to around 5% in 2022. In 2023, they were up even higher.
Okay, just want to make it clear that it wasn't as a result of the price appreciation,
no.
that it was the actual percentage.
The actual commission. And the reason that happens, it happened over the last 20 years. You can see when the market is really, really hot and it's easy to sell a home, commissions go down. So in 2005, 6, 7, and then they went up in 8, 9, 10, because that's when you need a really good agent to help you solve your need. And so in 2020 and 2021, commissions were lower than they were in the last 2 years because it was easier to buy or sell a home back then.
Makes sense. Well, hopefully we'll be able to have you back on in a different area of the cycle. We'll be able to chat more.
Oh, I cannot wait.
we keep saying it.
It's been over 2 years,
Yes.
or 2 years.
But it's going to be more years, isn't it? I mean, it is.
I think it's going to end up being probably 3 years at this pace.
Not 3 more. You mean one more.
One more, exactly. And in my mind, I'm thinking that we'll get to the mid-cycle at some point in the next 1 to 2 years, and it should be a gradual upturn.
So your expectations for this spring are pretty tempered, I would imagine.
My expectations for this spring are that it will be better than last year, but modestly.
All right. Well, Robert, thank you very much.
As we go to break, check out some of the biggest laggards on the S&P this morning. Got some earnings stories in there. Nucor from last night down almost 7. Bunch of other earnings movers to get to as well from this morning. UPS, Lockheed, and more. What investors need to know as we continue on this Tuesday.
A very busy day for earnings. UPS, some defense names as well on the move. Frank Holland and Morgan Brennan have been tracking the action. Frank, we're going to start with you.
Hey, good afternoon, David. Good afternoon from London, I should say. Looking at UPS stock right now, seeing a lot of movement after earnings, showing a 10% beat when it came to EPS. You saw the stock spike just about 3%. Then it later declined when the company reaffirmed that they would see their profit in the first half of the year fall 20 to 30%. Then if you look at it, you look at the chart right there, it's a 6-hour chart. You can see there was another spike back to the upside after the company laid out some of the details related to its Postal Service contract for air cargo. So here's what we now know about that contract from the company officials on the earnings call. It's going to be about a 5.5-year contract, and it will have revenue minimums, which really seemed to boost the stock after that news was released on the earnings call. The contract was previously held by FedEx, and there were some concerns that it could actually be money losing for UPS. And again, on the call, CFO Brian Newman laid out that also the revenue and the profit from this contract will go to its supply chain solutions segment.
Adding the USPS air cargo volume to our existing network will result in a higher share of the network cost being allocated to SCS, indirectly benefiting our U.S. domestic segment. We expect to see a benefit to operating margins this year at both the consolidated level and within the U.S. domestic segment.
It was really a mixed quarter overall, though. Volume decline of 3%, with air volumes falling by 8%. Again, that Postal Service contract is expected to help with some of that shortfall when it comes to air cargo. Pricing was essentially flat in the U.S. International pricing saw a very slight increase. The company also detailed the percentage of its U.S. volume that's small and medium-sized business. They now say that 29% of it is SMB volume. That's really key, that higher margin business, key to CEO Carol Tomei's bolder and better strategy. Back over to you.
Frank, thank you. Let's get to the defense names now. Lockheed Martin and Raytheon headed in opposite directions this morning. Let's get to Morgan Brennan with more on those and why they're moving the way they're moving. Morgan.
Yeah, we're really fading the gains here. It was a strong start to earnings season, Leslie, for aerospace and defense. A beat for both Lockheed Martin and RTX, both reaffirming guidance. Strong defense demand, and in the case of RTX specifically, strong demand for commercial aerospace despite those lingering engine recall issues. Now, Lockheed reporting a 14% sales jump. It was 5% if you stripped out that extra Q1 week. CFO Jay Malave pointing to growth in every segment as orders surge for missiles and munitions, missile defense, but also strength in F-16, international orders for F-35, radars, hypersonics, and Sikorsky's Black Hawk helicopter. Now, for Lockheed, margins still pressured in part from a classified program. For RTX, defense sales are
In the generative AI space, appearing on CNBC this morning, CEOs of Perplexity, that newly minted unicorn startup, and Anthropic, which makes the AI chatbot Claude. Our Deirdre Bosa was watching that, has some details on today's Tech Check. What'd you think, Dee?
Hey, good morning, Carl. Well, those two CEOs, they work in different categories of Gen AI startups. There's Anthropic, building the foundational models, and then there's Perplexity, which builds on top of many different models, the application layer. But what they have in common, they are both Google alums challenging the incumbent. Anthropic has backing from Google as well as Amazon, but its Claude 3 LLM also competes with Google's Gemini. And Perplexity is doing what Google is unwilling to do, a new user interface that totally embraces Gen AI and a new type of query that could replace search and, more importantly, search ads. Here is CEO Aravind Srinivas on Squawk Box today.
The incumbent is always our biggest competition, Google, because we are entering the search category. Except the difference is unlike previous competitors to Google that tried to take market share in the 10 blue link search engine market share. Instead, we're trying to create a new category called the answer engine, where you just get a direct answer to any question you ask, and it disrupts the whole 10 blue link user interface.
disrupting the whole user interface. That is something that Google has been slow to do, and with good reason. That could mean disrupting its whole business model, search ads. But Anthropic and Perplexity are examples of upstart Gen AI native companies with less to lose that are keeping the incumbents on their toes. When I spoke to Srinivas a few months ago, he told me how his time at Google inspired him to start his own company because there were so many researchers turned entrepreneurs there. And he's not alone. Call it the PayPal mafia for the Gen AI age, a group of former Google execs that have gone on to build the Gen AI darlings. There's Anthropic, OpenAI, Mistral, Character.ai, Inflection. That's just to name a few. All of those were founded by or led by former Google employees. So it's not surprising that anxiety is rising within Google itself. Our Jenna Elias broke details on a leaked meeting from Google's search chief, Prabhakar Raghavan. He told employees that if there's a clear and present market reality, we need to twitch faster, like the athletes twitch faster. The irony, perhaps, though, in all of this, guys, is that it is former Googlers implying pressure. I could go on and on the list of how many execs have gone on to found AI companies, and a lot of them say they wanted to ship. This stuff needs to be tested in the real world to gain any traction and to be perfected.
I was just going to say, isn't that part of a tried and true tradition? You had some former Googlers on your set just the other day.
Yeah, that's right. You've seen so many go on, and this is something that's happened over the last decades. But this race is seen as very different, right? The generative AI race is all about talent. Who do you have? That's what a lot of these companies are built on. And, you know, even in that meeting that the search chief had a few days ago, he said this isn't like the last 10, 15 years. This is different. And we keep hearing that message from Google that this time is different. They need, it's almost like an existential crisis, right? The innovator's dilemma that we talk about all the time. They need to figure out how to compete in this new era that could disrupt search altogether.
All right, Deirdre, thank you so much. Really appreciate it. Taking a look at shares of Goldman, they're about 4 cents above that all-time closing high. So we'll see if they can kind of continue that throughout the day today and close at an all-time high. Again, on the back of those strong results last week, earnings, tailwinds in capital markets, all of these things we see with regard to some M&A headlines, IPO headlines throughout the week. We've got Rubik on deck for tomorrow.
That's right.
Pricing. So we'll see how
and
that
Viking,
does.
as Bob said the other day.
Viking.
You mentioned
CBC.
Yes.
In Europe.
You mentioned the quarter, and of course we got an upgrade from Argus the day after, and the line was these are the kinds of environments in which the Goldman franchise shines. If you really are believing in an uptick in the IB environment. Meantime, tomorrow, it does feel like Boeing is going to be the main story. A lot of the anticipation sort of been built in, but we'll see what they say about backlogs and orders and production and whether or not some of these difficulties can be cleared up. For now, though, bulls trying to break the habit of a midday sell-off. Let's get to the judge in the half.
Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the bounce back for stocks and a very critical 72 hours ahead with major earnings reports and that key inflation read looming. The investment committee now debating the markets. Joining me for the hour today, Stephanie Link, Jason Snipe, Jim Lebenthal. We're all at Post 9. And we check the markets where this bounce back continues. Got the best two-day gain, Steph, for the S&P in about 2 months. You've got stable yields, 10-year yield dipping to about 458, at least at last check. So let's assess where we are after what was rocky last week, and we're getting a little bit back over the last couple days.
Well, we have a really big week, as you mentioned. We have a whole ton of earnings, 31% of the S&P 500 earnings this week. And you mentioned the tech names, really big and going to be pivotal, I think, for this market. But then we also have to get through the inflation number on Friday. And I think from what I've been hearing, a lot of people are really bared up for this number because they're looking at the CPI, they're looking at the PPI, and we're nowhere near 2%. But I actually think it's probably going to come in line because I think the PPI is more of a reflection for PCE in terms of the same kinds of components versus CPI, which is a big part of it is shelter. So I think if we get kind of like an inline number on Friday and we have probably solid earnings because we're already seeing solid earnings, I think that maybe we can see a bounce. We're oversold for sure. And oh, by the way, then not only have we been talking about the growth around the world being better than expected, here we're running at about 2.5% in GDP. We talked about last week the IMF raising growth to 3.2%, China at 5.5%. Last night we got the PMIs in India, and they're going to grow probably something like 7% in GDP this year. So I talk about the growth all the time because I think it does bode very well for earnings. And so far we have seen pretty good earnings across the board, from the P&Gs, the Pepsis, the Danahers. We're going to talk about some of the.
You know, Jason, we were below 5,000. You know, last week people were saying, okay, is 5% pullback for the S&P going to turn into 10% pullback? And, you know, once again, the bears were left wondering if that was it.
Right.
Do you think it was it? That was it? 5%?
Well, obviously it's possible. I mean, Steph makes a great point.
It's possible, but does it feel like? Give me something.
I don't think so in the near term, and I think the bounce is obviously
You don't.
encouraging.
Wait. You don't think that was it?
Not in the near term. Not in the near term.
Okay.
And I think it's encouraging. Just obviously viewing the technicals, we bounced off the RSI. It was around 30 for the NASDAQ. It was around 30 for the SPY, right? The S&P 500. So it's encouraging that we've seen a little bit of a bounce. I think yields, to your point, Scott, earlier that you mentioned, have been quiet. Gold came down around 3% yesterday. So this is a humongous week. As Steph mentioned, 30+% of the S&P is reporting this week. So we need to hear ongoing growth stories that we've already heard through earnings season. So I think we could get a catalyst from what Microsoft says, what Meta says, what Google says, and the like.
I think, Jimmy, we're at, what, 4% or so off the high for the S&P? I mean, you're at 5,061 as we speak. Goldman today says the market is still vulnerable on the idea of sticky inflation. Barclays urges investors today to fade any bounce and position for higher yields. It's the higher for longer comeuppance of sorts that, you know, we were wondering when it was going to hit, and maybe it started to hit late last week. Maybe it still will more. But the market's trying to make some kind of statement over the last couple of days, perhaps.
Yeah, and the inexorable march to 5% on the 10-year seems to be interrupted, at least for the moment. You know, those strategist comments, Scott, and viewers, what I would say is it's a question of degree. I mean, all of this is a question of degree. Jason, you were just saying, yeah, it could go down lower, but by how much? It could go down by 2% or by 7%. Right. Because if it's 2%, folks, I'm going to tell you something. It is very unwise to sell in anticipation of that. I really can't stress that point strongly enough. And let me rephrase it on the other side. Do you want to buy? Do you want to own stocks here? This economy is very strong. If we're talking about higher for longer, we're talking about that because of the strength of the economy, because the consumer is employed and will continue to consume, and because profits are growing, Stephanie. That's the point you just made. I mean, this is a very benign, intermediate to long-term situation. But in the short term, sure, 10-year yields could go back up to, you know, 465, 470, and that may freak the market out a little bit, but I would not sell in anticipation of that.
Steph, what do you make of what, you know, Barclays has suggested, fade any bounce, and Goldman says we're still vulnerable?
I mean, I think you can probably fade some of the tech bounces because they're still really over-owned. And I know that I think the setup is pretty good because some of these stocks are down 6-10% from the highs. But as I say, a lot of them are over-owned. I think you still want to be selective in tech. And yeah, I mean, I would probably be trimming some Amazon if we get a nice bounce because I've already had a really great bounce and it's not cheap. That being said, I think you can be selective and own other names that have come down even more so within tech. We can talk a little bit about the semiconductor stocks in a bit. Overall, though, I am very encouraged what I'm seeing in the industrials. I was very encouraged in terms of the action in financials. I mean, remember when JP Morgan reported, that stock was down 6%, and the whole group got hammered. And now it's kind of taking new leadership. So I like that.
All-time high today for Goldman.
And yeah, and for a lot of them act really well. And that's where I see value, Scott. That and then in energy. I mean, I thought Schlumberger's quarter was great last week. I actually added to it last week. So I think that there are places that you want to buy on dips and even maybe buy even into strength on some of the non-tech areas. And then when you get extremes in tech, on both sides, if we jump a lot higher in tech, I think you take your gains, and if you see some opportunities, there's that as well. But I don't want to. I'm not going overweight tech. I want to go overweight the other parts of this market.
What do you think about that, Jason? Because, you know, we've watched this rotation happen over let's just say the last week, where you've had money coming out of tech and going into whether it's financials or staples or healthcare or utilities. Now, I understand, of course, that some of those are going to be viewed more defensively than others, obviously.
100%.
Utilities, staples, et cetera. But there has been a bit of a rotation. And just when you thought, like other times, you thought that rotations were going to take hold, the dip buyers come in and say, you know what, NVIDIA at 750, I'll buy that. Now the stock's up $70 from the low of last Friday when it was down 13.5% last week. My point is, all of the mega cap tech stocks right now are green. NASDAQ had a good day yesterday. NASDAQ's having a great day today. Microsoft, Meta, Alphabet report this week. Steph says, I don't know if I'd be overweight them. I wonder if we're going to get a reminder this week from them of why we are overweight those names and why people continue to buy the dips and why the NASDAQ's not going to have an even bigger correction than the whatever it was, 7% or so off of the high that it did.
Yeah, no, Scott, I mean, there's a lot there. And I think for me, as we look to this week, I think, the point that or theme that I'm hearing is to degrees of growth, like for me, as it relates to the mega cap tech spectrum, guidance is going to be very important to me. AI application use cases, what that revenue looks like. Again, this is not a new narrative in terms of rotation. Tech was the 7th best performer in the first quarter, right? So rotation has been happening. We've seen it play out a little bit further. The story has played out a little bit further over the last couple of weeks. And I think, in terms of pricing to perfection, listen, we're expecting 40% year-over-year earnings growth in the tech spectrum.
Are these priced for perfection anymore? I mean, isn't that part of the recent pullback that they've had? Maybe they're not so priced for perfection anymore. And it's not like all of the multiples on those stocks are well above their 10-year historical averages either.
True.
There's several that are below.
Very true. And here's the thing. I think the names will do well. I think the reports will be strong. I think it's going to be about the guidance going forward because I think earnings growth is rotating into other areas, somewhat the cyclicals, the industrials, other parts of the market, and I think that's where you need to look to.
Well, I mean, Bank of America, their flow show, Jimmy says, large financials buying that they've seen last week, and that tech and discretionary is where the outflows were. Not surprisingly, last week, discretionary and tech were 2 of the 3 sectors that were in the red, whereas everything else, utilities, financial staples, healthcare, real estate, energy, industrials, comm services, were all in the green. What do you make of the flows?
Well, I mean, the flows generally are going to trace where the sentiment is. And I'm not so much a sentiment guy. I'm much more of a fundamental guy. And where this takes me, by the way, also the flows are backward looking. I mean, I want to answer your question, Scott, but I think the right answer is why are the flows going to go where they should go? And the answer to that is fundamentals. And, Jason was talking about the rotation. If you look at fundamentally what's going on outside of tech, I'm not going to take anything away from tech, but if you look at what's going on outside of tech, there is strong demand. I mean, these cyclical stocks, I don't care if it's airlines, auto manufacturers, the demand is really, really strong. I just looked at this, and sometimes I know this kind of irritates you a little bit, but I want to do this.
If you're bringing up the TSA thing, I'm going to leave.
No, don't leave, because this is important, and I think you're going to find it useful. I really do. Okay. This year to date.
It says TSA. I'm leaving. Go ahead.
I want you to stay.
I'm just telling the executive producer right there to be ready. Go ahead.
There have been only 4 days this year where TSA passenger counts.
He did it. He did it.
I'm out.
Oh my God.
If you don't find this useful,
Kevin, you can come. No.
If you don't find this useful, I mean, look, this is where I live. It's in fundamentals. Okay. There's only been 4 days this year where there has been lower passenger counts than last year. Only 4 days. On average this year, passenger counts has been 5% higher than the year prior on average. Look, people are traveling. I'm not taking anything away from technology, okay? And maybe these earnings are going to come out this week, Scott, and they're going to blow everybody away and they're going to do fine. What my point is, and this is to Jason's comment about rotation, there is fundamental reason for rotation to be occurring. And just a coda on this.
But it depends where you're rotating to. You bought small caps last week.
I'm so glad you brought this up.
I'm glad too. I mean, the Russell's down 6% this month.
Okay. In the last 3 days, and I bought it on Thursday. We didn't get it to Thursday. We didn't get to hit it there. But, over that time frame, small caps have done very well. They're doing very well today. They were actually up on Friday.
Well, they're part of the big bounce back. right? The Russell's back at 2,000.
Yeah.
Rates have stabilized,
Right.
if not come down a touch.
Right. Oh, I'm so glad you went there. Thank you, because that's what people perceive as the headwind for small caps is rates. And I think
perception's reality.
Okay, I love where you're going with this. Let's dissect the reality.
Complimenting me a lot after I said I was going to leave.
I know. I want to keep you here. I got to keep you. I got to keep you enthralled here. Okay.
Proceed.
Look,
I like where this is going. Proceed.
All right. Interest expense for small caps, folks, is 4% of their revenue. Okay. If interest rates stay high or even go higher, the issue is not that their interest expense goes higher. It's minimal. The issue is if it causes a recession. If higher for longer causes a recession. And folks, what I'm seeing from cyclical demand, we are very, very far away from a recession.
And that was my point about the inflation report on Friday. If it comes in line-ish, maybe a little hotter, a little cooler, then maybe rates can settle down and you can continue to see this rotation. And to your point on rotation, both of you, the Russell 1000 growth is up 640 basis points year to date. The Russell 1000 value is up 474 basis points year to date. That's about a 200-ish spread. In February 9th, that spread was 900 basis points growth over value. So we are seeing not just like various different sectors, you're seeing a style change too. And I think if interest rates can kind of stay where they are and stabilize, that will continue.
Yeah, well, you know, volatility in the bond market, we've learned many times, is not good for equities. Right. So if we get some stabilization, still on the conversation of, you know, betting either for or against technology stocks, we are learning that short sellers are profiting from betting against tech. Our Kate Rooney's been following the money there and has this report for us. Kate, what are we learning?
Hey, Scott. Yeah, so last week at least, the big tech bears saw a record windfall. That was during the NASDAQ sell-off. Short sellers in the Magnificent Seven, say that 10 times fast, right? Raked in a weekly profit of $10 billion. That was an all-time high, according to Ortex. Those tech giants, as you mentioned, Scott, have recovered a bit. They are the most shorted stocks in the U.S. That's according to S3. NVIDIA is number one, then Microsoft, followed by Apple, and then Tesla. There has been some negative sentiment around these names, but short interest may be more about using mega cap tech to hedge. It can be more efficient than going long other sectors. Over the long run, though, shorting big tech, it's been a lot less profitable. So NVIDIA shorts for the year are down 35%, Meta shorts down 27%. Amazon, Microsoft, and Alphabet bears are all in the red. And of that cohort, it's really only been profitable to short Apple and Tesla. So the Tesla bears have lost total $52.5 billion shorting Tesla going back to its IPO. You can see there only 2 years have been profitable for the Tesla shorts. This might be one of them. They're up $9 billion for the year. Scott, back to you.
Yeah, we'll follow it. Kate, thank you. SK Rooney, Elon Musk today, speaking of Tesla, which, by the way, you know, reports, as I think you know, in overtime on X, his X, the car business is tough, quote unquote, is what he said. I mean, that stock is down 42% year to date. Jimmy, they have just continued price cuts when analysts think they're done. They're not done. Do you have the direction of the company weighing on shares? How do you view this in what was once a very important earnings report for the overall growth trade? Now, as the market cap has come down, the market cap has come down, like been cut in half, basically. It doesn't feel like it holds that degree of importance.
That's a very good point. It may not be as important as the market cap comes down, but certainly I think for sentiment, and there's a lot of people for whom Tesla represents the sort of hyper growth trade of years past. Look, the unfortunate truth that's being found out right now is that it's a car company. And I know when I say that, some people, like, their hair stands on end, but I'm sorry, it is a car company. And when you are a car company, you have a lot of property, plant, and equipment that costs a lot. You want to get volume through those factories to cover the cost. How do you do that when the EV business is kind of in a bad spot here? You lower prices. And that's not good for overall earnings, but it covers the cost of running the factories. Now, some people are going to say, what about full self-driving? And I'm going to say, everybody's got it. I'm sorry. Everybody's got it. It's not something that's specific to Tesla.
They are the first mover, though, and the market leader in some respects. It's I think, a little over the top to be wholly dismissive of them as just simply a car company. Yeah, you can have issues, and probably rightfully so, with should it be trading at that much of a premium to other car makers, give you that, but charging network, battery technology, first mover technology, lead in EVs.
Moats to it. There's no moats to it. I'm sorry. There's competition in all of that. And, you know, when we talk about...
Does it necessarily need a quote-unquote moat?
Well, look, when I think about automotive companies and moats, what comes to mind for me and many other car investors is Ferrari. There's a moat. I mean, a lot of people will say Ferrari's not a car company, it's a luxury company, but those margins are completely defensible by the moat around Ferrari. What we're seeing in Tesla, if you went back a year and a half ago, people would say, look at the margins on Tesla. They're similar to Ferrari. That was then, this is now. They are now having to cut costs to promote volume through their factories.
The charging network might be a moat. I mean, if you want to go that granular.
It might be. It might be, Scott.
Why do you think the major automakers are doing deals with Tesla?
Yeah, I don't think that that's going to be enough to support the market cap where it is. That might be a moat. I'll grant you. I just don't think that's going to be enough to support the support the market cap.
We talk about, Jason, the importance of Tesla, you know, in terms of a stock and earnings, not necessarily where it once was. I mean, for all intents and purposes, we've removed it from the Mag 7 conversation, right? Stock down a lot, market cap cut in half. So we've taken it out. It means a lot, though, to Cathie Wood. I'll tell you that, because the flagship ARKK Innovation Fund, in which this is a large holding. Interesting read today in the Journal. The popular funds are sinking fast. Those are their words. Why? Because you've had a lot of redemptions. You've had investors pulling $2.2 billion from the active funds this year. That tops outflows from all of 2023. Here we are. We're just in April.
Yeah.
In all of 2023. Why? Tesla's down month to date 17.5. Coinbase is down 12. Roku's down 7. Block's down 13. UiPath is down 14. CRISPR down 16. Rates going up. Not the greatest time in the world to own. Not all of these obviously fall into this basket, 100%. But non-profitable, high multiple tech.
Yeah, and I remember us having this conversation a few years ago, Scott, when we were talking about the rate raising cycle, and we were talking about long duration assets and non-profitable stock and the impact that higher rates have on these companies. And I think you're just starting to see that ring true. Higher for longer story. We came into this year again. We've talked about this a lot this year. 6 cuts coming into this year, 3 cuts, now potentially 0 cuts. And what is the material impact on long duration stocks? Not good, right? So that's why we're seeing some of the price action that we've seen in these names.
You know where we've seen some of the greatest divergence in sort of, you know, these long duration stocks versus non-profitable versus stocks that have become profitable? Lyft versus Uber.
Yeah.
Take a look at the 1-year performance of these two names. I mean, it's so stark, right?
Yeah.
Uber's up 129%. I bring it up because you bought it.
Yeah. Yeah. So this stock, to your point, Scott, I mean, it's up 128% over the year, over the last year. It's up 14% year to date. So for us, we've been looking at this for quite some time. We saw a little bit of a material pullback over the last few weeks. It's about 16% off its 52-week high. Gross bookings are up 22%. Mobility up 29%. Delivery booking up 19%. They are hitting on all cylinders. Dara has struck a new culture at Uber, and I just think there's a lot of earnings potential going forward. There's almost a 50% growth rate, so we like this one. We decided to add a small position.
Right, you know, I'm getting that, Steph. It's, you know, free money. A lot of boats rise in free money. When money's no longer free, you see who's got the bathing suit on and who doesn't. And the divergence between Lyft and Uber has been so dramatic. But, you know, it's obviously not just that kind of stock. But how do you view some of these high growth, non-profitable names that have gotten an AI, in some respects, halo effect from some of these other stocks and now are coming back down to earth in a sharp way?
So for me, I can own maybe 1 or 2 of them in my portfolio. I'm very valuation centric. We all are. But there are some fun stories out there. Maybe Uber is one of them. I think of Snowflake as being mine, the one that I have not been right on, but I do think that it's an exciting story when you can talk about a company that has 22% product revenue growth, 30% total revenue growth, billings, bookings up 30%. Like, these are real numbers. Fine, the stock is not cheap, and that's why, and it's a long duration asset, and so, you know, higher interest rates are going to hurt it, and then you have to execute, which I would argue they did execute last quarter, but you had a CEO change and that sort of thing. But I think you can own maybe one or two of these. I think you definitely want to have the total addressable market stories in AI, cloud data center, cybersecurity. We talk about all the time that I don't think gets nearly the respect that it should. And I have a very big position in Fortinet, but it also trades with the rate story. So for me, I would rather be less susceptible to kind of the rate story and more just focused on fundamentals, valuations, and have a few fun names, maybe they're not even in my benchmark, to create some alpha.
So can we throw up the let's throw up the S&P if we could intraday. We're going to take a quick break, but Jamie Dimon is speaking at the New York Economic Club, and whereas he's been known, I think, fairly of late to characterize his comments as more cautious than not on a number of different topics, is now saying, quote, the economy is booming. And then it's been booming for a while. He does say that current, and this really echoes where he has been of late in terms of the cautionary comments. He says the current geopolitical situation, quote, probably the most complicated and dangerous since World War II. So, whereas he is giving, the economy the credit that certainly he sees, and he has as good a look as anybody on the stability and strength of the United States economy. He is obviously still concerned about some of the issues and flashpoints around the world. But we're going to take a quick break. There's your highs of the day for the S&P. There's Mr. Dimon on the left speaking not too far from here. We'll monitor that. We'll come back. We'll talk about committee stocks on the move next.
Are you following the Halftime Report podcast? What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
All right, we are back. Let's do some committee stocks on the move. First, to the man in the stock that has gotten more mention on this program than arguably anything else in the history of this broadcast.
I just said I'm not going to do TSA anymore.
Cleveland Cliffs. Down sharply today. Can we see the stock, please? Down 6% year to date. I mean, I feel like, look, when the stock has big moves like this, especially down, you mention it a lot.
I do mention it a lot.
This is on earnings? They missed, right?
Yeah, headline miss on the top and bottom line. But, look, as far as why the stock is down, sometimes the market does things that are unexplainable and gives you an opportunity. And I think this is one of those times. When you see a stock that's down 9%, you think to yourself, is there something fundamentally wrong with the company? Is there something wrong with the economy that we don't know, particularly for a steel company?
I mean, they missed their earnings and sales. So what
yeah, but not by a lot. Look, let me cut to the chase. The business outlook is very, very bright for Cleveland-Cliffs. The cash flows, you look at EBITDA, it's up something like 70% year over year. There was a slight decrease in buying from service centers and distribution centers after the UAW strike. That is behind us, okay? What you're looking at right now is the auto industry, notwithstanding Tesla, outside of Tesla, is going quite strong. We'll get to that in a second. Their costs to produce steel are going down. Volumes are up, prices are going up. Now, here's what the most important thing is. I'm buying more shares. I strongly disagree with the market reaction today. And you know who else is buying shares? Not today, but in a couple of days when the blackout period is ended, is the company. They announced a $1.5 billion share buyback. That's roughly equal to 17% of the company's market cap right now. Over the last 2 years, they've buried 11% of the shares outstanding. I'm not talking about share buybacks to sterilize options issuance. I'm talking about a decrease in the shares outstanding, which increases my ownership and will continue to do so in a company that I tell you the future is very bright for.
Financial engineering. That's what they call that.
Yeah, I call it getting a much greater share of a company that I really like, whose earnings are growing.
You think, let's just assume that the Nippon and Letter X deal doesn't happen. Mm-hmm. Where does this company fit in that?
If they do anything, it's going to be at a much lower price than when Nippon Steel was going to pay for U.S. Steel. There was obviously a lot of talk on the conference call about this, and I think there was at least one analyst who seemed a little hung up about, whether Cleveland-Cliffs might be able to peel off some assets from U.S. Steel. Look, that's not Cleveland-Cliffs' game. Cleveland-Cliffs' game here is to see what happens with this deal, whether the president nixes it as it says, and if that happens, they're going to come in with a much lower bid. And that's going to be good for the company.
All right. The Cliff CEO, by the way, is an exclusive interview today in overtime. So you don't want to miss that. GE Aerospace, they beat, right? They raised their guidance too. 52-week high today, Steph.
Yeah, they're hitting on all cylinders. They really, truly are. Especially orders were up 34% in the quarter. Adjusted revenue up 15%. Operating margins up 40 basis points, year over year. Free cash flow was double from last year. They have a $15 billion buyback. They increased the dividend back in March. So I think a lot of good things are happening, and I just want to stay on board.
You want to give me something on GM, Jimmy?
I want to give you a lot on GM. First off,
they raised their guidance. Stock's up 25% year to date.
Yeah, outside of EVs, the auto business is very strong. Period. Now, what's also strong is GM's. I don't like this term financial engineering. I understand why you say it. I respect it, but I don't like it.
I mean, that's what people say.
I got it. Not you in particular, one in general.
It
okay?
Kind of is what it is.
It is what it is. Now, here's what it also is. With the amazing cash flows that this company has been generating for 2 years, 3 years actually, and the cash balances that they've had during that time, they've bought back 17% of their shares in the last quarter. I mean, just, period. That's it. They did that accelerated share repurchase. It's showing up in a share count that is 17% below, than a year ago. Apologies, not in the last quarter. And at the same time, the demand for autos is there. Demand for internal combustion engine autos is there. They've got good pricing. They've got good volumes. The UAW and this idea that the UAW took GM to the cleaners is an absolute farce. The UAW got a good deal. GM managed to cut costs elsewhere, and they're doing extraordinarily well. Right. Last thing on this.
Yes.
If you want to think about a price target on this, I'd put around 70, and here's why. Stock trades at about 4.5 times the upper level of their earnings range. Traditionally, it's sold at 6 times, and what I think you're going to see as this cycle continues is that it goes through that historical multiple of 6 and gets to 7.
All right, price target to 70 for Farmer Jim. Freeport, Steph, they beat. They raised their guide.
Yeah.
You own the stock, right?
Yeah. I think their guidance for cash costs, copper cash costs, are going to be a little bit higher than expected. I kind of feel like they always do this. Stock always trades down on the earnings. It's an opportunity. Remember, for every 10 cents per pound change in copper, that's $400 million plus in EBITDA to the company. So very levered to copper. I like copper. because of the reasons I mentioned in the first block, that the global growth is actually stronger than expected. But copper production was actually up 12% in the quarter, and that was a beat. And I thought the overall quarter was good. So I'm a likely buyer. It's not down enough for me today to buy more, but I'm a likely buyer if it continues to be weak.
Okay, that company's CEO, by the way, is on overtime as well. Let's get the headlines now with Julia Borston. Hi, Julia.
Hey, Scott. Well, former National Enquirer publisher David Pecker has resumed his testimony in Donald Trump's hush money trial. This after earlier the judge held a hearing on whether Trump violated a gag order. Prosecutors are seeking $3,000 in fines for the first 3 posts on Trump's social media account they say violated the order. The judge has yet to make a decision. Ukraine has restricted consular services for military-aged men living abroad. This is in an effort to increase conscription in its war against Russia. In a post on X, the country's foreign minister said, quote, staying abroad did not relieve a citizen of their duties. The Eurostat database estimates about 860,000 Ukrainian men were living in the European Union as of January. And Taylor Swift's latest album, The Tortured Poets Department, became the most streamed album across Spotify, Amazon Music, and Apple Music, breaking records across all 3 platforms at its initial release. Spotify reported that the album was streamed 300 million times on its first day. Scott, I have to admit, I was at least one of those streams. Back over to you.
All right, Julia, thank you. Julia Borston. Up next, we have 4 bullish calls on 4 committee names. Calls of the day next.
NBC.
At Barclays, reiterate overweight. The latest quarter, similar to the prior one, fell better than muted expectations into that release, they say.
Yeah. Listen, I mean, the price action in the stock has been solid this year. It's up 10% year to date. The print was solid. I mean, it was a top and a miss on the top, some destocking issues. But I think they managed to navigate through some of the inflationary pressures fairly well. I mean, margin, I think, there's a little bit of talk about China. China's, I think it's priced into a lot of different stocks. It was down 10%, not 15. But I like this one. I think they're managing the environment well.
You want to talk about Qualcomm too, which was initiated as a buy at benchmark. Price target 200, well positioned as an AI leader in smartphones and PCs. Quote, we believe Qualcomm is the company that's best positioned to bring data processing and intelligent functionality to the edges of the network, enabling cloud edge convergence through total connectivity.
Yeah, so Qualcomm, another story that for me, the price action has been positive. Over the last few years, I haven't been as excited about the stock, but we've talked a lot about handsets. The Android sales are starting to come back online. IoT diversifying of revenue with automotive growth has been solid. Trading at 15 times forward, so the multiple has come up a little bit. 11% growth rate. But I do like the AI story and the application there. So I continue to like this stock.
How about Costco? Price target to 710 at Citi. Stock closed yesterday at 715. They reiterated as neutral.
Yeah.
What do you make of that call?
So Costco, I think one of the concerns has been a little bit of softness in the discretionary spend. What's really interesting as well is Kirkland brand, is now $67 billion in revenue, which is larger than Coca-Cola, right? So put that in perspective for a minute. But I like this new management, newest CFO there, the annuity stream and membership growth. I think I continue to like this one. I think it's the best of breed in the staples in those stories here.
Jimmy, Disney, price target to 141 from 128 at Wells Fargo, reiterated, overweight, remains optimistic on the long-term direct-to-consumer profitability.
Well, I'm glad to hear that. I'm optimistic on it as well. I think that's one of several things that can and should go right, so profitability and streaming. The other is related to that, getting the Hulu deal done, which does seem to be taking a long time, so hopefully that's near to come. Theme parks continue to hum along. Maybe we get some growth from studios later in the year as well. So I think there's a lot of things that can and probably will go right at Disney.
All right, we will take a quick break, and when we come back, our senior markets commentator, Mike Santoli, will be right here at this desk with his view on today's action.